Starting a new business comes with countless responsibilities: product development, marketing strategies, customer acquisition, and more. However, there's one aspect that many entrepreneurs overlook: maximizing tax write-offs. Understanding these deductions isn't just a formality. It can mean the difference between giving away thousands of dollars in taxes or reinvesting that money to fuel growth. In this video, we'll explore the top 5 tax write-offs every new business owner should know. These insights could significantly affect your bottom line, so stay tuned to learn how to retain more of your hard-earned income in 2024 and beyond. Startup and organizational costs. Before a business officially launches, it often incurs preliminary expenses. These can include market research, promotional activities, employee training, and travel to meet suppliers. Additionally, there may be costs related to the legal and structural setup of the company, such as incorporation fees or organizational meetings. Here's the key point: up to $5,000 in startup costs and $5,000 in organizational costs can be deducted during the first year of operation, provided the total doesn't exceed $50,000. Any remaining amount is generally amortized over 180 months, starting when the business generates revenue. Determining when your venture transitions from the startup phase to an active trade or business stage is also crucial. Typically, this occurs once the company earns income from its intended activities. Before that point, all qualifying expenses should be tracked as startup and organizational costs. The deduction becomes available only when the business moves beyond the planning stage and starts operating as intended. 2. Equipment and technology. Essential tools of the trade: computers, cameras, phones, machinery, office furniture, and specialized software can all qualify for favorable tax treatment. Under the de minimis safe harbor rule, items costing $2,500 or less can often be fully deducted in the year they're purchased, avoiding the complexity of long-term depreciation. For more expensive assets, Section 179 allows the cost of qualifying equipment to be deducted immediately rather than depreciated over several years. In the 2024 tax year, the maximum Section 179 deduction is $1,220,000. On top of that, bonus depreciation at 60% provides an additional opportunity to accelerate deductions for qualifying purchases placed into service this year. Taking advantage of these options can streamline tax planning and enhance cash flow. If the strategies covered so far seem helpful, consider subscribing to this channel and hitting the notification bell. This ensures you never miss a video packed with valuable tips to help optimize your business finances. 3. Home office deduction. For businesses operated from home, the home office deduction can be a game changer. If a dedicated part of a residence is used exclusively and regularly for business, a portion of mortgage interest, insurance, utilities, repairs, and depreciation can be deducted. There are 2 approaches here. Regular method: deduct a percentage of actual home expenses based on the space used for business. Simplified method: deduct $5 per square foot of qualifying office space, up to 300 square feet. Evaluating both methods can help determine which provides the most beneficial deduction. Vehicle expenses. If a vehicle is used for business purposes, the associated costs, fuel, maintenance, insurance, and depreciation, are potentially deductible. 2 methods exist. Standard mileage rate. In 2024, the rate is 67 cents per business mile. For example, 10,000 business miles would yield a $6,700 deduction. Actual expense method. Deduct a percentage of the actual vehicle-related costs based on business usage. Certain larger vehicles that exceed 6,000 pounds gross vehicle weight rating may qualify for substantial first-year deductions through a combination of Section 179 and bonus depreciation, significantly reducing taxable income. 5. Meals. Business-related meals, such as those taken during business travel, meetings with clients, or professional conferences, can often be partially deducted. Generally, these meal expenses are 50% deductible, as long as they serve a clear business purpose. Meanwhile, meals provided to employees on the business premises, like a company-wide gathering, can sometimes qualify for 100% deductibility under the de minimis fringe benefit rules. These 5 deductions: startup and organizational costs, equipment and technology, the home office deduction, vehicle expenses, and meals, can significantly reduce the tax burden for a new business and preserve critical working capital. Keeping detailed records, including receipts and logs, ensures that these deductions are properly substantiated. This level of documentation helps maintain compliance with tax regulations, and reduces risk in the event of an audit. For more insights on maximizing business tax efficiency and financial management, subscribe and check out the other videos on this channel. It's time to put more hard-earned revenue back into your business's growth and success.